Hi, I'm Linda Eedes, and this is an update on the RECM Global Felxible Fund, looking specifically at the third quarter of this year. So it was another good quarter for the Global Felxible Fund. The fund was up 5.4% after fees versus its benchmark, which is an inflation-based benchmark of CPI plus 6%, which returned just over 2% for the quarter. That was actually mainly driven by the global portion of the portfolio. In fact, we've been increasing our allocation to global stocks over the last few quarters. You'll probably know that contrary to what you might expect given the political situation, the Rand over the last year and a half has actually still strengthened quite significantly. So we saw that retracing a little bit in the last quarter, which obviously boosted any funds which had quite significant global allocations, but obviously did have a negative impact on the more sort of domestically focused South Africa incorporated type equities, which we do think are undervalued on the local side. But within the global portion of the fund, we had started to take advantage of the Rand strength to actually sort of start increasing that allocation. But also what we like about the global portion of the Global Felxible Fund is that increasingly we were able to build a very diversified portfolio of really great businesses, in many instances businesses that have grown out of family-owned businesses, which specialize in providing a specific product or service into particular industries across a wide range of geographies. And so we sort of have a portfolio that is very robust in the sense that it's very well diversified, and the underlying quality of that portfolio has improved quite significantly compared to 2 years ago, when obviously there was quite a big concentrated exposure to resources businesses, which are very cyclical, quite volatile as a result, and also obviously lower quality for that very reason as well. So the global portion of the fund is actually now almost half the portfolio in comparison to the local portion of the fund. The global portion does still have a bit of cash. I think that's completely appropriate, but what is very important about that cash allocation is that it sits not in US dollars, but in fact in sterling, which is still undervalued in terms of inflation differentials, and euro and yen. So we're actually sort of moving away from holding dollars, which we think is a little bit rich, and actually in other currencies which we believe are also undervalued. But really one wants to have a bit of cash in one's global portfolio, given where we're seeing sort of markets at the overall level. I think there will be great opportunities coming up where we can buy businesses that we really sort of want to own, but obviously we want to pay the right prices for them. So that gives us the dry powder to do that. On the local side, of course, as I mentioned, the Rand depreciating did have a bit of a knock-on negative effect for a lot of the sort of local industrial businesses, but in the local portfolio, the resource positions, which are sort of reducing over time as those stocks rally, those did come through on the local side, and we do have some resource exposure in the global portion of the fund as well. So what you're seeing is that resources allocation has shrunk quite considerably, especially if you sort of consider the backdrop of resources as a whole up, in the region of 60 to 70% since the beginning of 2016. You would expect us to be bringing that exposure back and increasing our allocation to other parts of the market. And there we're sort of picking up quite a few interesting businesses on the financial side, and also obviously quite a mix of industrial businesses as well. On the global side, we actually introduced 3 new sort of retail-oriented businesses to the portfolio, but operating in quite different markets and different geographies as well. The first of these is actually a US retailer, Williams-Sonoma. Very high quality business. They actually provide sort of luxury homeware. One of the brands you might recognize is Pottery Barn. And this is a business which has a track record of delivering returns on equity of in excess of 18% pretty consistently over cost of equity over time. We were able to buy this business on a PE of around 13. It's got a dividend yield of close to 3.5%. It's still got quite a long growth runway left. It's an absolute bargain for a business of that quality. The other 2 retailers that we bought were in the UK, in fact. Very different segments though. Carpetrite, which is a flooring retailer, and Next, which is of course the dominant clothing retailer, both on the high street and online as well. And both of those sort of benefiting in terms of having attractive prices, we were able to actually sort of introduce them at prices which are lower than what you would expect through the cycle for these businesses, simply because of course that consumer environment has been a bit depressed. And also the impact of the uncertainty of Brexit has come through on the pound, and that has sort of had a bit of a knock-on effect for those businesses as well. So both those investment cases are predicated on those businesses being dominant in their spaces, having the economies of scale to obviously weather that sort of downturn in the cycle, and obviously we're able to sort of take a little bit of a longer-term view, look through the cycle, and not just value the business on how it's doing today. Both of those with very good intrinsics, which will stand them in good stead through time. On the local side, one of the sort of significant new stocks into the portfolio was FirstRand. If you actually look at the South African banking sector in general, credit demand is sort of the lifeblood of that industry, and that's actually remains very muted. So one does want to start looking at having some exposure to this industry. So we looked at the excess returns that the banks have generated over their cost of equity, and FirstRand, if you actually look at its current price to book ratio, pricing in the excess returns that it's delivered over time, it's actually sort of pricing in about 10 to 12% growth from this point, which we think is very reasonable given where we are in the cycle for banks. And so FirstRand is really sort of our preferred exposure in the local banking industry. So to summarize, the Global Flexible Fund is a portfolio which enables us to find value opportunities for South African investors, but wherever we find them. So globally, locally, across the asset classes, it really gives us the widest opportunity set to take advantage of value opportunities as they arise. And we prefer to invest in value opportunities which are in good businesses. So quality for us is very important. That's quite a high bar at the moment because quality has obviously been quite a theme over the last few years. But interestingly, we are able to find increasingly very good businesses which just are not being focused on. So I think the portfolio is very nicely diversified at the moment. It's split fairly evenly between South African businesses, global investments, and it's poised to do very well, especially given the fact that value as a style is poised to do very well going forwards.